thank you very much for the invite to come and speak today at the conference. What I'm speaking about today is, the title of my presentation at least, is Fold, Hold, Double Up, What Hand to Play Next. Now obviously that's something of a cryptic title, but what I hope to do today is give you a comparison and contrast both the supply-demand balances for a range of sectors that we cover at MSI. Not only will I look briefly at supply and demand, but I'll also go on to look at what's going on in the earnings market, where we are today, where MSI sees us going in the next few years, before finally getting on to the prices, and then what is the winning hand. So to start off on the demand side, this is a chart that shows seaborne cargo growth, both historically and MSI's forecast for the next 4 years. We've taken this from a number of MSI's independent sector models, and as you can see, the real take-home message from this chart is that the next 4 years we are not going to see any negative seaborne cargo growth. Across the board, everything is appearing positive. And if we try and do a comparison of where we've come from and where we're going to, and we rank the sectors by seaborne cargo growth, we can see that historically it was the bulkers and LPG in the last 5 years where we've seen the strongest cargo growth. Looking forward, we think this will flip. We think it will be containers and LNG that are going to post the strongest seaborne cargo growth figures. And the arrows at the bottom give you an indication of the movement over time. So chemicals, containers, LNG are the clear winners if we're comparing history to the forecast. The poor OSV markets at the bottom of the chain there, they are at the bottom in the history. They're also the bottom of our forecast for the next 4 years. What I want to do now is just zoom in and take some highlights from some of the specific demand side sectors and give you a flavour of some of the interesting developments we expect to see sort of towards the end of this decade. And the first sector I want to look at is product tankers. This chart shows you incremental product imports by region. And you can see 2017, we're only expecting to see around 20 million tonnes of incremental product imports. This is obviously due to a lower oil consumption, but also the drawdown in stocks that we've seen building up over the last few years with a relatively cheap oil price. Looking forward, the strength in the macroeconomic environment, and then we're looking out to 2020, the implementation of the IMO 2020 sulfur regulations, where we expect to see a lot of diesel and MGO having to be transported from the Far East to the West to service ship bunker demand, we think is going to increase product tanker cargo significantly in 2019 into 2020. So that shows a positive story with regards to oil products. On the bulker side, what I plan to do is just focus in a bit on the Capesize market. And as you can see, the chart on the right-hand part of the slide shows you the discharge of bulkers and whether they're in China or the rest of the world. And you can clearly see that at the moment it still remains that the Capesize market is very much a Chinese bet. Around 60% of all Capesize bulkers last year were servicing the Chinese imports of commodities. Now, this does present a problem, we think, looking forward, sort of 2020 out to 2025. And the reason I say that is based on the chart on the left-hand side of the slide. What we're expecting to see is a structural shift in steel production within China. Now, the Capesize market and the iron ore market in more general has benefited significantly from the substitution of domestically produced iron ore in China for cheaper, better quality, lower priced iron ore from the international market. We think that substitution will hit a limit at around 2020, 2021, where we expect to see only around 5% of iron ore produced from the Chinese domestic market. Now, at the same time, there's a double whammy. we expect to see increasing amount of steel produced via electric arc furnace production rather than basic oxygen furnace production. This doesn't need the iron ore volumes that we've been seeing in the last 15 years. It uses essentially scrap steel, and we think there'll be enough scrap steel within the system by the start of the next decade to start to see electric arc furnace production share in terms of steel production increase significantly. This was obviously a bad sign for the dry bulk markets. Electric arc furnace, additionally, is also less polluting than oxygen furnace production of steel. And we're looking to reduce its pollution and its emissions. We think that this, again, is a strong reason for China to be switching to electric arc furnace production of steel. On the container side, I think finally we're starting to see some solid trade growth. And I expect most of you have heard that the Asia-Europe market has picked up significantly. We're forecasting that to be around 4.6% in 2017. But for the container market to operate efficiently and for the cascade to work, we need to see growth on more than just the Asia-Europe trades. And this we think we will certainly start seeing a lot more of in the north-south trades. This chart obviously is quite striking. We've seen 2 years of trades into Latin America and Africa in negative growth territory. And as you can see from our forecasts, we are relatively positive on both of these north-south trades over the course of the next 5 years, which bodes very well for the container ship market. And I thought I would just dive into one of the specialist sectors that we cover, and that's chemical tankers. This chart shows you the incremental capacity production and incremental consumption of chemicals, organic chemicals, by region. And you can see there's a huge build-up in capacity in North America and the Middle East and in China. Now, of course, the thing to take home from this chart is, although we're seeing a lot of build-up in new capacity in China, our forecast is the Chinese consumption to exceed the Chinese capacity significantly within the next 5 years. And obviously, we expect, therefore, to see a trade between the Middle East and North America moving volumes of organic chemicals to China. But, of course, the actual seaborne cargo only tells you part of the picture. And what we have to do is take that seaborne cargo growth and translate that into the number of ships we need to service the movement of cargoes from A to B. And this is what we do within our models at MSI. And within that equation, you have to factor in quite a lot of efficiencies and inefficiencies that are built in within the systems. Let's see if this one works better. You have to understand the routes that the cargoes are going into, i.e. the bilateral trades, the distances the cargoes are travelling on, the speed of the vessels. Obviously, this has a huge impact into the effective supply within the fleet. Port waiting times, i.e. you're taking vessels effectively out of the fleet if the vessels are sitting there waiting to load. Operating days, ballast ratios, the carrying capacity of the vessels, and when you're bringing into forecasting, you also have to allow for size changings. Obviously, we've seen some rapid size changing in things like dry bulk carriers and container ships over the last 10 years. So when we're looking out 5, 10 years, we have to be factoring in those sorts of dynamics within to our modelling system. And what this all enables us to do is work out how many ships we need to service incremental cargo growth. Now, I've taken MSI's headline numbers, and to keep things simple, I've just translated that into one vessel type for crude oil tankers. I've just assumed everything goes in a VLCC. Dry bulk carriers, I've assumed everything goes in a Cape-sized bulk carriers. But you can see the incremental cargo growth leads to a requirement for additional ships, assuming we're starting at equilibrium in day one. Around 50 VLCCs, around 250 Cape-sized bulkers between now and the end of 2019. But again, we've only still got part of the picture. We've looked at the cargo growth, we looked at the requirement for shipping, but what we have to do, of course, is marry this up with the supply to get a full sense of the picture. And the most imminent supply threat, of course, is the order book. If we compare the requirement for shipping against what's currently on the order book, we can see that across the board, almost, we've got too many ships on the order book to meet incremental demand requirements. That goes for all the main sectors and also drifting into the specialised sectors. Only really car carriers do we think that we potentially need to see some more orders within the next 2.5 years to meet incremental cargo growth. But the supply side has a three-card trick up its sleeve. It can pull out reduced contracting, it can increase cancellations, and it can increase scrapping. So I want to look just briefly at these three cards. On the contracting side, contracting volumes have been very low. And I thought it was worth trying to put this into some historical context, comparing it to the size of the fleet. As you can see, for tankers, bulk containers, if we aggregate 2016 and 2017, the last 2 years in comparison to the size of the fleet have been the lowest contracting volumes we've seen since 1980. That even goes the fact that we've seen a lot more oil tankers, VLCCs ordered this year, but contracting is low. Cancellations, well, cancellations are still happening. I would say there's a downward trend in terms of cancellation volumes, especially for the tankers and the container ships, but you can see that the dry bulk market is a lot more responsive in terms of cancelling vessels, and we've seen some significant volumes within the last 2 years. So cancellations, we do think, will carry on to play an important part in the supply side dynamics. And then there's scrapping. And I think the thing to worry about on the scrapping side is the age of the fleet. This is the age of a number of sectors of shipping, and we can certainly see that the majority of ships within the world's fleet at the moment are under 10 years old. This, of course, presents a problem. On the positive side, what we have seen is a reduction in the age of vessels when they're being scrapped. Between 1980 and 2008, we never really saw this happen. Regardless of the markets, we saw the average age of vessels scrapped increasing up and up and up and up. Since 2008, we've certainly seen this metric reverse. And of course, last year we saw a number of vessels under 10 years old in predominantly the Panamax container ship sector being scrapped. So that's a positive to bring to the supply-demand balances. And I think another interesting aspect is the almost two-tier system that's developing in some markets. This chart shows the effective trading speed of dry bulk carriers. And it's easy to see that vessels here, under 15 years of old, are all trading at sort of optimal speeds at around 11 knots on average. Whereas vessels over 15 years of age are certainly travelling a lot less quickly, effectively. Now, we're not saying that these vessels are doing 6 knots. What we're saying is that a lot of these vessels are underutilised, are waiting for instructions, are drifting around and waiting for a new charter. So there still remains a large chunk of the dry bulk fleet that could potentially be scrapped based on this efficiency metric. So looking at supply overall, what we can see is, looking forward, the supply growth picture looks a lot more favourable for the industry than it did in the last 5 years. Across the board, we're expecting to see lower growth than we saw in the period 2014 to 2016. On the earnings side, I think it's worth just reflecting where we're currently sitting on the earnings cycle. Now, this is just a schematic. It's for illustrative purposes only, just to give a relative sense of one sector to another and where they sit relative to the curve. But you can see that it's our view that the tankers have still got some way to go before they hit the bottom. Everything else is pretty much bunched up, either at the bottom of the market cycle, or is starting to show some signs of improvement and some recovery, with Ro-Ros sitting at the top of the cycle at the moment, or near the top, due to long underinvestment within the sector. Very, very little Ro-Ro ordering until very recently over the last decade, and they're finally getting their chance in the limelight. Where we see earnings going, now this chart shows you where earnings currently are. That's the red dot. The thick line in the middle is the historical median, and the green dot shows you where we think the forecast will be by 2020 in terms of annual averages. Across the board, you can see that the green dot is higher than the red dot. That's the first good thing to take home. Majority of the time, the green dot's appearing higher than the median, but there are some sectors that we think will struggle to get back to those historical medians. And this is, of course, a good lesson in why we shouldn't be using things like mean reversion to forecast the future, because you're either going to under or overshoot. I think there's only one instance here on the chart where we actually are on the mean if you're using a 2-3 year mean reversion forecasting technique. Moving on to new build prices, we think new building prices play a very important part generally within the market, but also in determining second-hand values. And to understand the new building price dynamics, you basically have to look at two fundamental aspects. One is the yard forward cover, the relationship between shipyard capacity and also the shipyard order book, and the other is to look at shipyard costs. And that's something that we try and do at MSI, bringing together in our ships model. The yards, as I'm sure you're all aware, are suffering. And although we've seen some relatively strong contracting in 2017, if you look at contracting compared to deliveries, we can see that order books are naturally shrinking. There's a lot more tonnage being delivered than is actually being contracted across the board. So I thought I'd just try and look at the relative health of the main big shipyards, both in Korea, Japan, and China. And the health of the order book I've taken here to look at the number of vessel types a shipyard has taken order for and is on the order book, the number of owners that are on the order book, as well, and the size of the bubble represents the size of the order book. And you can see here how Hyundai, with all its many facets, is sitting way above everything else, biggest order book, most owners, and also the most number of vessel types. This is mid-2015. If we flip to today, we can see that Hyundai, the bubble has shrunk, it's come in, there's not as many owners on the order book, and also the number of vessel types has also come down. If this slide thing worked, I'd go flip between the two, but it's not working particularly well. But the thing to say with Japan was we've not really seen a change in the position or sizes of those bubbles. So those big Japanese yards, it's almost business as usual, whereas the Korean yards are the yards that are really suffering given the capacity that they built up in the boom years. Yeah, it's 3 clicks to go once. What we therefore think is we will see a further reduction in shipyard capacity. This chart shows you shipyard capacity along with forward cover, and we've seen some significant reduction in effective shipyard capacity. We think there's further to go. This reduction in shipyard capacity then gives us a chance to build up forward cover and new building prices to recover going into 2020 into 2021. To the flip side, we've looked at forward cover, we've got to look at costs, and this is our average cost index. And as you can see, measured against 2009, the actual costs to build a vessel today are around 10% lower than they were in 2009 in dollar terms. If we split that up into the main geographical shipbuilding regions, we can see there's a huge difference between Korea, where effectively prices have gone up or costs have gone up. If we look at Japan, there's a huge reduction in costs, largely driven by the currency. movements over that period. So this supports the idea that Japan is currently a lot better placed than some of its counterparts in Korea in terms of shipbuilding. So our view is that new building prices will bottom out this year, going into next year, depending on the sector. And then with a reduction in capacity and an increase in contracting, we'll start seeing an increase in the new building price. Just quickly on the second-hand prices. Second-hand prices, in our view, are driven by new building price, they're driven by earnings, life expectancy and scrapping. So it will come as no surprise, given our positivity towards new building prices within sort of 2-3 years, our positivity towards earnings, that we expect to see second-hand prices improving pretty much across the board once you get past sort of mid-2018, if we're looking at something like tankers. So there's a positive story and an asset play to be had on the new build, on the second-hand prices, which brings me on to my final slide. What is the winning hand? So for this winning hand analysis, what I've done is effectively said, if you go out into the market today and you buy a 5-year-old, and you keep that 5-year-old and you sell it in 2020, what sort of gains or losses can you expect purely on the steel? I'm not, in this instance, not factoring any cash flow, any earnings or any operating costs. This is just a pure steel asset play. I've run it through our online FMV system, which enables you to get a forecast for a range of individual vessel types. And as you can see, at the top of the tree, in our asset play, the winning hand at the moment is, perhaps surprisingly, HTSs, the small HTS market. But of course, those values are very distressed at the moment, so it's all relative. We're then sort of looking at the sort of mid-Panamax size container ship. Again, asset prices are still low. But I think the thing to say here is, although we've got some negatives, some relative losses, if we were just saying that there was a straight line depreciation from a 5-year to an 8-year-old with a 25-year life expectancy, we would expect to lose 12% of asset value over that 3 years. So there's only really the VLCC and the MR1 markets where we actually expect to see asset values depreciate less than straight line depreciation, given our movement in second-hand prices. And I haven't had time, but there's always the trump card. And we've yet to see how that one really plays out. Thank you for listening.